Hey, everybody, and welcome back to Investing Talk Podcast. It's January 21st, 2025, and today we're going to be taking a closer look at Carvana.
Uh-huh.
That's CVNA on the New York Stock Exchange. You know, the online used car giant that's been making a name for itself.
Yeah, they've had a wild ride.
They have.
Their stock is currently sitting at $232.32,
Wow.
which is up 1.83% from yesterday.
Okay.
Pretty impressive when you consider that it more than tripled throughout 2024
Yeah.
after almost hitting rock bottom.
Talk about a rebound.
Right.
But is this a sign that they're finally in the clear, or are there still some bumps in the road ahead?
Well, there's definitely a lot of positive buzz around Carvana right now.
I've seen that.
RBC Capital just upgraded them to outperform and set a price target of $280.
Nice.
And Citi also gave them a buy rating.
So what's making the analysts so bullish on Carvana?
Well, they're seeing real improvements in Carvana's financials. The company's been focusing on becoming more operationally efficient.
Okay.
For example, they've streamlined their logistics network, which has helped reduce their delivery times and costs.
Makes sense.
And there's also a lot of talk that their sales could exceed expectations in the coming quarters.
That's good news for investors who stuck with Carvana through the tough times. But let's be real. There was also that pretty damning report from Hindenburg Research late last year.
Yeah.
They alleged some questionable accounting practices and even hinted at potential stock manipulation.
Yeah, that report definitely shook things up.
Yeah,
Carvana's stock took a 13% hit after it was released.
it did.
But it's important to remember that many analysts defended Carvana,
Okay.
suggesting that Hindenburg's claims were overblown. In fact, JP Morgan actually doubled down on their overweight rating, indicating that they believe the company's underlying business is strong despite the controversy.
That's a great point. It highlights the importance of doing your own research and not just relying on one source of information, especially when it comes to something as impactful as a short seller report. How should investors weigh this kind of information when making decisions?
Well, it's crucial to look at things holistically.
Okay.
Don't just focus on the negative headlines. Dig deeper into the company's financials, their management team, their competitive landscape, and their overall strategy.
That's good advice.
And consider the source of the information.
What?
What are their motivations?
Right.
Are they presenting a balanced view? It's all about developing a well-rounded perspective.
Speaking of strategy, Carvana hasn't been shying away from making big moves even with the Hindenburg situation hanging over them. They're building a huge new auction megasite in Atlanta.
I saw that.
It's supposed to create 200 new jobs.
Wow.
And they just partnered with Rush Soccer, which is a smart move to increase brand awareness, especially with families and younger demographics.
Yeah, I like that move.
Me too.
Those are some really smart initiatives by Carvana.
Yeah.
They demonstrate the company's commitment to growth and innovation. And they align perfectly with that analyst confidence that we talked about. By expanding their operations and strengthening their brand, Carvana is positioning itself to capitalize on the growing used car market.
So things seem to be looking up for Carvana.
Yeah.
But what about the overall market?
Yeah.
Are there any red flags investors should be aware of?
Well, the Fear and Greed Index is currently at 39, which indicates that the market is leaning towards fear.
Okay, so what does that actually mean for someone who might be considering buying Carvana stock?
Well, on the one hand, this fear-driven sentiment could actually lead to some undervaluation.
Okay,
Stocks might be priced lower than their true worth just because of general market anxiety.
I see.
But on the other hand, it also suggests increased risk and volatility.
So it's kind of a double-edged sword.
It is. It might be a bumpy ride in the short term.
So maybe not the best time to go all in on risky bets.
Probably not.
Are there any other potential risks on the horizon?
Analysts are warning about potential headwinds for high-valuation tech stocks, especially with rising interest rates and persistent inflation. This is definitely something investors should keep an eye on, as it could impact Carvana's performance.
Good to know. Now let's look at the numbers. What does Carvana's technical snapshot tell us?
All right, let's break down some key indicators, starting with moving averages.
Okay.
Carvana is currently trading above its short-term moving averages, which is usually a good sign.
Okay.
But it's slightly below its 50-day moving average, suggesting some resistance might be forming around that level.
Interesting. What about the Relative Strength Index, or RSI?
The RSI is currently at 57.42, which puts Carvana right in neutral territory.
Okay.
It's neither overbought nor oversold,
Okay.
so no clear signal from the RSI right now.
All right, let's move on to the MACD, the moving average convergence divergence.
Right now, the MCD is in negative territory, which usually suggests bearish momentum.
Yeah.
However, given Carvana's recent price action and all those positive analyst ratings, this could actually present a contrarian buy opportunity for investors who are comfortable with a bit more risk.
Okay, a lot to unpack there. But as always, we need to remember that these indicators are just tools, not guarantees.
Exactly. They can provide valuable insights, but they should never be the only factor in your investment decisions. You always need to consider the bigger picture, the company's fundamentals, market trends, your own personal risk tolerance, and your investment goals.
Absolutely. All right, we've covered a lot of ground in this first part of our look at Carvana.
We have.
We've explored the analyst sentiment, addressed the Hindenburg report, examined Carvana's strategic moves, and looked at some potential market risks. We even dived into the company's technical indicators.
But there's still more to uncover. You're right, we've only just scratched the surface. Now let's shift gears a little bit and consider Carvana's position within the broader market. Who are they up against in this used car battleground?
That's a great question. It seems like everyone's trying to get a piece of the used car pie these days.
Yeah, you're not wrong. Carvana's facing competition from all sides. Traditional used car dealerships, of course, but also online platforms like Vroom and CarMax.
Right.
And we can't forget about those peer-to-peer marketplaces like OfferUp and Facebook Marketplace where people can buy and sell cars directly.
So with so many players, what makes Carvana stand out? What's their unique selling point?
Well, Carvana's really differentiating factor is their relentless focus on a fully online, hassle-free experience.
Okay.
No more haggling with salespeople or spending hours at a dealership.
Right.
With Carvana, you can browse their huge inventory, secure financing, and even trade in your old car, all from your computer or your phone.
That's a level of convenience that's hard to beat. And they've really made a name for themselves with those car vending machines, too.
Yeah, those car vending machines are not just a marketing gimmick.
Right.
They're a visual representation of Carvana's commitment to innovation and customer experience. They're all about creating a seamless and memorable experience, from browsing and buying to delivery and beyond.
So they're shaking things up, that's for sure. But can this online-only model really go head-to-head with the big players in the long run? What does Carvana's growth potential actually look like?
Well, the used car market is massive.
It is.
And it's expanding rapidly, especially with new car prices continuing to rise.
Right.
Carvana is in a prime position to capture a big chunk of that market. Their tech-driven approach allows them to scale quickly and efficiently, reaching customers all over the country.
But there must be challenges too, right? What could potentially slow Carvana down?
Of course, there are always challenges. One major concern for investors is profitability. Carvana hasn't consistently turned a profit yet, and they're spending a lot of money to fuel their expansion.
Yeah.
They need to prove that their model can generate sustainable earnings over time.
Makes sense. Investors want to see a return on their investment, not just growth for the sake of growth. What else could pose a threat to Carvana's success?
Logistics is another big one.
Okay.
Managing a nationwide inventory of used cars, handling deliveries, and providing after-sales service is a complex and expensive operation.
Yeah.
Any disruptions to their logistics could damage their reputation and impact customer satisfaction.
So they need to keep those car vending machines running smoothly.
Exactly. Plus, the competition is getting fiercer every day.
It is.
Not just from traditional dealerships, but from other online players who are constantly innovating.
Right.
Carvana needs to stay ahead of the curve to remain competitive.
It sounds like Carvana's at a critical point. They have a lot of potential, but also some serious obstacles to overcome. What are the key factors that will ultimately determine whether they succeed or fail?
Here's where things get really interesting.
Yeah.
First and foremost, execution is everything.
Okay.
Carvana needs to demonstrate that their online-only model can deliver a consistently positive customer experience from start to finish.
Right. That means reliable deliveries, transparent pricing, and top-notch customer service.
So no room for mistakes. Every interaction matters.
Right.
What else should they be prioritizing?
Data will be crucial.
Okay.
Carvana has a treasure trove of information on customer preferences, buying patterns, and market trends. They need to use this data to optimize their operations, personalize their offerings, and anticipate customer needs.
Data is king, as they say. And what about their financials? What needs to happen there?
Profitability is key. They need to find ways to reduce costs improve margins, and show investors that they can consistently generate earnings.
Because at the end of the day, that's what Wall Street cares about.
And finally, they can't afford to become complacent.
Right.
They need to constantly innovate, experiment with new technologies and business models, whether it's virtual reality test drives or AI-powered pricing algorithms. They need to stay one step ahead of the competition. So a lot on their plate, but also a lot of opportunity if they play their cards right. With the right strategy and execution, Carvana could truly disrupt the auto industry and become a major force in the years to come.
Absolutely. It'll be fascinating to see how their story unfolds. They've already defied the odds by bouncing back from near collapse. Now they're pushing the boundaries of what's possible in the used car market. It's a story of resilience, innovation, and ambition.
And a healthy dose of risk. But that's what makes the investing world so exciting.
It is.
So for our listeners who are considering adding Carvana to their portfolio, what's the key takeaway?
Carvana is not for the risk-averse. It's a high-risk, high-reward stock. If they can navigate these challenges and harness their growth potential, the rewards could be substantial. But if they stumble, the losses could be significant.
So it's a classic buyer beware situation, but also a potential opportunity to invest in a company that could redefine the auto industry.
Exactly. It all comes down to your individual risk tolerance and investment goals. Are you willing to bet on Carvana's ability to overcome these obstacles and become a leader in the used car market? That's the question you need to ask yourself.
Well said. We've covered a lot of ground today, from Carvana's competitive landscape and growth potential to the key factors that could determine their success.
But we're not done yet.
We've talked about Carvana's business model, their competition, and the challenges they face. But there's one more layer I think we need to peel back, the bigger economic picture.
Right. Carvana doesn't exist in a bubble. The overall economy can have a major impact on their performance, for better or for worse.
So what are some of these macroeconomic factors that could affect Carvana's trajectory?
Well, interest rates are a big one.
Oh, okay.
The Federal Reserve has been hinting at potential rate hikes in the coming months.
Right.
This could make it more expensive for people to finance car purchases, which could lower demand for both new and used cars.
So rising interest rates could put a damper on Carvana's sales? What about inflation? That's been on everyone's mind lately.
Absolutely. Inflation eats away at purchasing power.
Yeah.
And it can make people think twice about big purchases, like cars.
For sure.
If inflation keeps climbing, it could squeeze Carvana's margins and make it harder for them to keep their prices competitive.
So interest rates and inflation are two potential headwinds for Carvana. Are there any positive economic trends that could work in their favor?
Yeah. One potential bright spot is the strength of the job market.
Okay.
If unemployment stays low and wages keep rising,
Right.
consumers might feel more confident about making major purchases, including cars.
So a healthy job market could give Carvana a boost.
Mm-hmm.
What about consumer confidence in general? How are people feeling about the economy right now?
Well, consumer sentiment can be unpredictable,
It can.
but currently it's relatively stable. People are still spending, but they're also being cautious.
Yeah.
Carvana will need to keep a close eye on consumer behavior and adapt accordingly.
It's a delicate balancing act, for
Yeah.
sure. So we've got these economic forces at play, creating both opportunities and risks for Carvana. What's the bottom line for investors? How should they be thinking about Carvana within this complex economic landscape?
It's all about incorporating these macroeconomic variables into your risk assessment.
Okay.
Carvana is already considered a high-risk, a high-reward stock.
Yeah.
If the economic winds blow in their favor, think low interest rates, controlled inflation, a strong job market, their growth potential could be magnified.
Yeah.
But if those winds shift in the other direction, if we see a spike in interest rates or a surge in inflation,
Yeah.
it could make their existing challenges even tougher and put their path to profitability further out of reach.
So tread carefully.
Yeah.
Carvana is a company with a bold vision and a disruptive business model, but it's also facing some significant headwinds, both internal and external.
Precisely. It's a stock that requires close attention, careful analysis, and a willingness to accept both the potential rewards and the inherent risks.
Well put. We've covered a lot of ground on Carvana, from their unique approach and ambitious plans to the competitive landscape and the economic forces that could shape their future.
We've given you the information and the insights you need to make informed investment decisions.
Now it's up to you to decide if Carvana is a stock you want in your portfolio. Remember to do your own research, consider your risk tolerance, and never invest more than you could afford to lose. This is Investing Talk Podcast. Thanks for tuning in. Don't forget to subscribe, share this episode, and leave us a comment. We'd love to hear your thoughts.